As I mentioned, who's going to be with us today. He, of course, a famed finance professor of the Wharton School. Professor, it's good to have you on. Just give me your thoughts on what is top of mind for you. You just heard our report about what's coming out of Switzerland, the impact that it's had on the market all day long.
Well, Scott, I hope that this knocks some reality into the Fed and Chairman Powell. You know, we've been talking about the big inversion, biggest in 40 years of the term structure. Certainly, SVB went down on that inversion. Now, yeah, bankers are not supposed to borrow short and lend long. We know all about that. But there's a reason that every recession in the last 50 years has followed an inversion. Something blows up, something goes wrong. I think this ultimately could be good because if you look at the futures market right now, they're saying one and done, and then a decline. As you know, I've been saying that they've been way too tight for the last 6 to 9 months, actually, and have to look at the liquidity, the inversion, and I think that those realities are finally seeping in. I hope they're seeping in to the Fed.
What should the Fed do next week?
Well, assuming that no further crisis in the next 7 days, I think what's going to happen is they are going to do 25, but the message is going to be a likely pause. They won't commit to a pause, but they're going to say, look at the producer price index that we got, a very good news this morning. They're going to say we're beginning to see good progress on that inflation front. We know the bulk of monetary tightening is yet to be felt. And given the financial climate and the risks, we could afford to pause in our tightening. They won't commit it, but I think the language is going to be totally different from the language we had after the last meeting.
Well, you just said that's what you think they'll do. I want to know what you think they should do.
Well, I thought I don't think they should raise it. I didn't think they should have increased last time because the bulk of the monetary tightening, the fastest increase in Fed funds rates and real rates in at least 40 years, was showing progress. You know, we talked about the distortion in the actual, particularly consumer price data and housing. I talked about the fact that I thought that the war against wages was inappropriate. We need to raise wages to bring labor into the labor force. And by the way, I thought it was a very promising labor report. We had 0.2% increase in the U2, the U6 unemployment, a little bit of a loosening. He's going to use that language. We see a little bit of a loosening of the labor market. Of course, tomorrow morning we'll get initial jobless claims. It certainly did jump up on 1 week, but that's a volatile series. We're going to see what's going to happen tomorrow on that. But he could change his story looking at the so to speak, slowdown side rather than only looking at the troublesome inflation areas. And I think he should have been looking on that slowdown side for very many more months. So what he should do is not increase at all. But I think he's going to increase 25 with a very big change in language. What's going to be interesting, Scott, is the dot plot, because normally the bank presidents and the FOMC fills it out, 1 or 2 weeks beforehand. I think it's totally different after SVB than before. I hope they get them all a chance to revise it because it was going up to 6. And now, If you take a look at the futures market, it's barely going to 5.
Yeah. So, Apollo said today, when the facts change, my view changes. This is from somebody at Apollo, Torsten Slok. A financial accident has happened. We're going from no landing to a hard landing. The Fed will not raise rates next week, and we have likely seen the peak in both short and long rates. Isn't he right? I mean, we just had an accident.
That's actually a quote from John Maynard Keynes, who said, when the facts change, I change my opinion. What do you do, sir? He once responded. And I read Torsten's Slack's comments on that. Yeah, I mean, again, I think they shouldn't. But my feeling was, I'll tell you why I think they're going to go 25. If they suddenly go zero, it could worry the market. Oh my goodness. I mean, they're giving up on that. Are they so worried about the economy that everything they voiced and all the opinions they've had over the last 6 months are now throwing aside? I think a more measured way of doing is 25 with a pause. We are seeing progress.